Hey everyone, thanks for clicking on another one of my videos. Today we're going to do a trade recap. We're going to go over 3 trades. I took one trade today and it was a winner, over about 20R. Then I had another trade set up that happened at the end of my trading session when I usually go to bed. I did my markups, I let the chart on, it tapped, it was in, but I did not take the trade on my actual account because I tend to go to bed at that time. And it did hit take profit, which is a beautiful trade. And then I had another setup that presented itself around 5 a.m. my time. I'm not awake at that time, so I'm still going to show you the markup. The whole idea behind this of why I do trade recaps, today in particular, we're going to do about 50R of trades. I took a trade that was 19.69R. Personally, the other 2 trades I did not take, but I'm still going to do the markup. The reason why I do trade recaps is when you're watching all these YouTube videos and all these courses on how to trade and strategies and this and that, every time that they make those videos, it's obviously all made in hindsight. And the thing is, people handpick examples that are near perfect scenarios that nearly never happen, right? And so it's so easy to teach somebody if I can pick a specific scenario that just really proves my point. But the reality is that the market is very imperfect, and you have to be quick, you have to be adaptable, you have to be able to react to what the market is doing, what price action is telling you. And so I believe that it's much better quality to learn off of a trade recap because you're seeing like actual same day price action. I'm showing you trade recaps of almost every trade that I'm taking during a week, for example. So like, I'll pick one of the days that I trade and I'll take, for example, that session and I'll turn it into a trade recap. And I like to particularly pick sessions where the market's a little bit more confusing, things might not make sense, where it's complicated, because I want you to be able to see how imperfect the market is, but to see how you can still spot beautiful scenarios, great entries, like near amazing setups, that are like unbelievable, but the reality is they're so easy, you can find them all the time. You just have to be patient and you have to have a trading plan. You have to know what it is you're looking for and pre-qualify your trade before you take it, right? You have to understand why you're taking your trade, what's your stop loss before you take an entry, what's your take profit before an entry, what's the higher time frame narrative. It's important. So I hope that you learn when I make these trade recaps what the real market price action is like. I'm showing you specific trades that I take, and today I'm showing you 2 trades. One trade that I had set up on my trading view that got triggered in, that was perfect, that I did not actually take with my actual personal funds, and another trade that I was asleep when it was trading, so I'm just going to show you the markup. They're all beautiful flips. I think that's something that's going to be really helpful for you to learn. It'll just open your mind to seeing the markets from a new way. And let's get into it. So to start on the higher time frame, the story, right? I've gone on my other trade recaps for the last week where I talk about the daily and the weekly time frame, how important those are. We're not going to go into that this time in this video because the reality is nothing's changed. We're still ranging on the 4-hour. We can see that we have an extreme, we have the swing low, the swing high, took out some structural liquidity, but this did basically just mitigate another supply zone on the 4-hour. We got an aggressive reaction. You can see price was kind of building a supply chain heading down, basically came in, somewhat mitigated our 4-hour demand. Price pushed up, liquidated the supply chain that we were building, reversed once we mitigated something in here, probably on like the 5-second time frame. Price is pushing down. What are we creating? Another supply chain. We're building up liquidity up here to take internal range liquidity, and we're building what looks like manufactured liquidity when we are mitigating every move just before that. And the reason why we do that is to have no resistance when we take it out. So it's a very clean move with no resistance. What do we get? We reacted. We took out the previous low wick that's somewhat mitigated. We got a deeper mitigation into this 4-hour demand zone that was respected. We did not liquidate this. We basically just got a deeper mitigation. what did we get? The reaction was so strong from here. The price pushed up very aggressively, created a sponsored candle that took out internal range liquidity. This was a full-bodied candle close with very little wick that took out liquidity, internal range liquidity, right? And from here, what did we get? We had price come back to mitigate something in here on a lower time frame. Price melted, and then now what do we have? We have this low that mitigated a 15-minute demand within this wick, and now we have price pushing up. So to paint the picture, that's what's been going on. Currently, this is a weak low. It failed to break swing structure. So this is a weak low. We're going to have to get more orders by breaking this level. So price is going to, in my opinion, it's going to go short. The question is from where? From here or from a little bit higher up. This is also technically a weak high because we did not break swing structure either. We just took liquidity and that was it. We got an immediate reversal. So the lows are very weak. The highs are weak, but I think the price is going to come lower first, right? So right now it's just a couple days before Christmas. I mean, one thing that I just wanted to say is most people will tell you not to trade during the holidays or, you know, in December. A lot of retail traders are going to say that the markets suck and there's no volume in the markets. And while there might be some truth to that, a lot of times people are just projecting their insecurities of their performance onto the market. The reality is the market provides beautiful setups every single day. You can never blame the market. The market might be choppy, price action might be ugly, that might be unclear, but the reality is that your interpretation of the market is just wrong. The market will always have a setup. The market will always present an opportunity. It might be on a different time frame than the one you're looking. You might have to drop down lower time frames, but there's always opportunities. So one thing to get out of your head is, you know, you could be trading the day before Christmas. It doesn't matter. There's always going to be something. Don't let somebody tell you that it's a bad time to trade, because there's never a bad time to trade, right? It just depends on the way you trade, your strategy, your trading plan. As long as your setups fit your plan and your risk management, take them, right? Trading the news is the same thing. Trading the news is not difficult by any means. It can be easy to get taken out if you don't know what you're doing, but the market will tell you what it's trying to do before it does that. So it's very predictable in that way. So anyways, from the 4-hour, let's drop down to the medium time frame. So we're going to go down to the 15-minute. It's a pretty big jump, but there's a lot of details that I wanted to go over here. So on the 15-minute, what do we have? This is a 4-hour time frame. This was a sweep of liquidity that we received. We basically reacted from the 4-hour, came down. We did not break structure. We still held demand, continued to grow, push price back up. What do we get? A mitigation of the 15-minute here. And then price at this moment started to turn around. We got a change of character and price flipped from here. This was the, let's say, the lower high, right? And then price started pushing down. This is when we mitigated something on the 15-minute. And on Sunday, we did have potential long opportunities to take up until here to this zone, right? Now, what I wanted to go over is two things. One, on this chart, one thing to keep in mind is if we take from the swing high to the swing low, let's say like this, obviously, I'm sure some of you guys have already heard of the premium or the discount kind of theory, right? So usually when we take let's say a swing, let's say swing structure from a high to a low or from low to a high, you usually want to look for trades when price is in premium. That's where you want to go short from. When price is at discount, you want to go long from discount. And so does that mean necessarily that we're just going to buy because we're in discount? No. Does that mean we're going to sell because we're in premium? No. The whole idea behind this is to kind of simplify that, hey, don't be focused so much on lower time frame let's say point of interest on the low end of the leg for shorts, because the reality is they're just going to provide opportunities for pullback, but more than likely price will usually have to come into premium before it let's say corrects itself, before it sells. And so you can see that price did have a strong reaction to this point of interest here that we had that was above the premium line, right? So above premium, we have 1, 2, 3 point of interests. Therefore, if structure is bearish, let's do this, then what I'm looking for is, I'm looking not to, let's do it like this. That way you can kind of see what I'm talking about here. Let's say this is from the low to the high. What I'm not looking to do is to take short opportunities from here all the way down. They could work out. They might work out a handful of times here and there, and you might get some good examples. But to be consistently profitable, you want to make sure that you fit this into your plan where you are only taking, let's say, shorts from premium and you're taking buys from, let's say, discount. If you found an opportunity, there might be a point of interest here. More than likely, it's just going to provide a pullback to continue on the move. There might be a point of interest here. Once again, it might just provide a pullback. And the reality is price is going to do this until it hits a point of interest that is going to be, let's say on, if we're looking for shorts, a supply zone on the premium. And when that happens, all that's going to do is take out all the liquidity we were building up, right? And so that's important to just keep in mind, something that might be helpful to you. So when I'm looking at this chart, these were the point of interest, 1, 2, 3, 4, 5 that I marked up myself. These are the ones I'm interested in. Now, I'm not interested in shorting from these. I'm interested in taking short opportunities from these depending on how they react, right? Because I'm a reaction-based trader. I'm not just setting limits on all of these orders. That would be just silly, right? Some people trade like that, not my style. Let's break down what happened when we took this trade and what's going on, right? So to focus on what's going on is during Sunday session price, we had price pull up until here. In New York, what we had was a pullback that came down, and Asian session basically was an accumulation here. So in Asian session, we were building up liquidity right here and building up liquidity here. I'm going to break that down more in a minute, but what I wanted to highlight was a flip zone that we had here. So what we had here, price was pushing itself up, price came into this flip zone or supply zone, right? It was a supply zone. We got a reaction. Price came down and formed an extreme here and then came and created a supply failure. It broke the supply. And so what we had is this point of interest in here that basically broke and took out this liquidity and pushed up into this higher time frame. What we had on this higher time frame was reacted to another or a higher point of interest, right? This was a higher point of interest. We did get a change of character on the bottom side, but we did have equal highs at the top, which equal highs are liquidity that's being built up ready to be taken. So that is something that I was cautious about. Price pushed down. We're going to go down to a 5-minute time frame to show you more details here. And we're going to get into the actual trade, right? So right here what we had was price reacted, pushed down, price came back up, pushed down. We have relatively equal lows here, but this did wick a little bit below. Price came up, pushed down. We have an order block somewhere in here, and this is where the breakout occurred. So I highlighted this area as a demand zone. Let's see which one in particular was highlighting. I think I was highlighting this buy candle here, something like that. That's what I was highlighting. Price came up. Here basically we have this low, creates this new high. So this is the low. If we're going long, the low should hold, correct? Because we're protecting the lows, targeting the highs. Price came up, made this high, came down and took out this low. Therefore, what do we have? We have a reaction to a 15-minute point of interest that just took out the low that came in to mitigate the 15-minute. So that's already telling me that we're having some bearish order flow, some bearish intentions are being shown from here. At this point, what am I looking for? I'd be looking for shorts. Now, this was not a session I was trading. This was the day before leading up to our opportunity. Price pushed up. What would we get? This swept equal highs here and then tapped something in here on a lower time frame on the seconds. Once again, we have still formation of relatively equal highs. And then what do we have? Price comes down here, taps this, we get a flip reaction. So in this case, and this is important, this is another flip. we have this demand. Let's do this. This was a demand that came up, took out some highs, right? Pushed down, we had a reaction. So point of interest reaction, formation of an extreme, then we get the failure of this demand. So this demand failed. Let's mark this as a demand flip. Failed from this extreme. And this is unmitigated. And also we left no structure in here, so no inducement in this long drop-off that we had. Price came down, tapped into this, let's say, 5-minute or lower time frame demand zone that we formed that was also a flip, right? So here we have one flip. Price came in, formed price reacted, formed an extreme, failure, and took it out. Once again, we're looking for something in here, right? And that's this zone. Same thing happened up here. Price basically created a high by taking out some levels. Point of interest reaction forms an extreme. That extreme results in the failure of that demand. So we're looking for what? Mitigation of this zone, right? Potentially for shorts. What we have here forming is two things. Let's turn on this lower time frame. We have, and then my refined zones. Might be too early for those. So lower time frame zones. So what do we have here? We have the formation of what looks like a developing demand chain. This demand held. This demand held. What did it result in? Price, we have this high, price pushes down. We get a reaction here. And these are everywhere, right? You don't have to be so picky. Reaction, failure, right? So this demand failed. It was another flip. This low, price pushed up, made a high from here, came down, mitigated, got a reaction, price came up, failed. This was a potential zone. Look how well this was respected. Let's go here. What does this do? Price comes down. Does not what? Does not take out the low. So what? We have demand being respected. What do we have from here? We have a buildup of liquidity in here. And then price pushes up and does what? It takes out these levels. Look at this. That's a liquidation. So we just swept this high. So right here, in a way, we're technically getting a change of character, right? Because from here, we got a change of character telling us we have bearish order flow, and that's exactly what we had. Demand failed, more shorts. But so in this case, we had this 15-minute point of interest showed us that supply is in control. This 5-minute or so demand zone is showing us that demand is now in control, because now as a result we're forming a demand chain, which also shows us that we're building up some liquidity here potentially, right? That's what we're seeing. We're building up what looks like a trend line. We don't really use trend lines, but what we see is this is a demand chain that's been holding. So we have 1, 2, 3, 4 times that price is holding demand, and so this one is responsible for breaking the supply here and taking out liquidity. So at that moment when I saw this was during Asian session trading, I immediately knew that I'm going to look for longs. And so let me show you my trade setup. We're going to go down to the 1 minute right here, kind of in this area. This is what I was doing. So price had already taken out this supply, and we know demand is in control. And so what I was looking for was, how is price going to react here? So this was the extreme that created the point of failure. So at this point, this was the area that I was looking at to take longs from, right? So This was the extreme. It was unmitigated. We're building up liquidity here. We have liquidity here. We have some structural liquidity here. What do we get? Price comes into tap. Let's show you my entry setup here. So what I did was I took the, let's say, my tool here, my entry tool, and I just created the, let's say, how do I call this? Sorry if I'm messing up. It's kind of rough. It's kind of still a little tired. So basically I took this massive sell candle, and what I did is I refined it to this buy candle that ends up, we have some sort of pullback here. This is where we have a push up, price mitigates, comes back down, and then this is where we get the explosion of price. So technically you could have highlighted this entire candle like this. I decided just to do it like this because it's very short. This is a small zone anyway. It's half a pip. So this was the area I was interested in because anyways, usually I will look for a 50% mitigation in that case, right? So it's not too big of a zone. I was waiting for price to come back. At this moment, this is where I got my trade entered. This was around, what time was it? 21? 22 is what, like 10 p.m. or so? Around 10 p.m. I got entered into the trade. Let me show you my actual entry here. This was my entry. So I got in at the 25%. It did come down to the 50%, which would have cut my stop loss. And let's see my stop loss here. The stop loss would have been cut by half a pip or so, not by much. So this was where I got my entry. At this point, we had liquidity that we were building up that we just took. We got a reaction from here that was pretty aggressive. Price came up, broke out from this level here. This was the last push down. This was obviously still the extreme. So we did not yet get an official change of character because I would still consider this the high. Price came up. What do we get? Pushing back down. We mitigated something in here, but price was doing what? Price was building up some liquidity up here. We get further pushed down. At this point, this trade, I was thinking, well, maybe it's just not time yet for this to take off. Usually the best trades will come like at midnight and onwards. But what we did get was, price did hold this demand zone. So, and that's the important thing, is at the end of the day, if we're creating a demand chain, right, price should hold the demand. Now, what I could have done is just, to be safe, is taking this entire range here and protecting myself against it by having a 3 pip stop loss, right? And that still would have been great. It still would have been a 1 to 9 almost, or 1 to 8.5, right? But the reality was, the reason why I took this trade entry was because this was the extreme, right? And in here, I'm going to show you the, let's say how I got my entry, right? So price comes up, it's building up, right? Let's say we have this low. We get price pushes up here, comes back down. We liquidate this small position here. We tap the bottom of the extreme, and we liquidate that by a little bit. Price is then building up, and then takes out what? This high. This high took out this low. And so when price is pushing up, we're building up some liquidity here, and this officially creates a breakout. This is the area of interest, right? And then what do we get? We get a reaction here that came to respect this demand zone, which is about how big? It's about 1 pip, right? And that's why going on the lower time frame, it's much better. A lot of times you can see this probably like on the 15-second or 5-second, it would have been great. But to keep it simple on the 1 minute, because I know most people don't get below the 1 minute, this would have been a great place to look. This is already a great entry because this was showing what? We have a demand chain forming on a lower time frame that's holding. We did get a liquidation. This high was strong, but at the same time we took it out anyway with this demand zone, so we got a reaction here. This area was unmitigated, and therefore that's why I was looking for a price to come into that zone. We did build some liquidity here. We built some structural liquidity at the top that we were going to come to take out. And this is how I took my trade. I set an order here. a 1.3 pip stop loss was just enough. I could have even kept it at probably 1 pip. It would have been less than a pip had I taken a 50% equilibrium trade. Price came here. You cannot get discouraged when price doesn't immediately explode out of your zone. And if you set your trade to break even pretty quickly, sometimes you're going to miss a lot of the moves. In this case, a little patience was required. After price came in to tap in, we hovered here for about an hour and 20 minutes. We did come a little bit deeper into this, a little bit deeper than the 50%. What we're basically just doing here is building up liquidity to take. Once we got this push up and we liquidated this position here, this liquidity that we were building up, at this point, this could have been a secondary entry. Now, I didn't do that, obviously, but this would have been a great place to enter, because what did we do here? This was the extreme that took liquidity, that swept and showed us bullish intention, an injection of bullish orders into the market here on the lower time frame. This was at 11 p.m. Price came in to tap into this demand zone and then took off. Oops, let's lock that. And then so how did I take this trade? Basically what I was doing is I was waiting for price to come into my zone. You can see how price was very aggressively moving away from the entry, and as we know, now demand held, so we're continuing the formation of a demand chain. Price pushes up. What do we get here? We got a reaction to a 1 minute, let's say, order block. This was the flip zone. So remember how earlier this area was responsible for creating the flip. So price came here, pushed up, took out the liquidity at the top. We got a reaction. This formed an extreme. This extreme broke demand. So this was an area that was going to be important to look at later. And what did we get? We got a change of character from it. Now, the thing is, at this time, at almost midnight, we still had much higher to go. I'm not going to necessarily take a reversal from a 1 minute time frame, because the reality is that if I'm targeting a 15-minute zone and I picked a strong demand chain, there's no reason for the demand chain to fail unless I was wrong about the direction of the market. And therefore, I knew price had to continue to go higher, right? So I wasn't going to get out of a trade and suddenly go short because of this. But I did decide to mark up because I wanted to make sure that I knew what was going on. We had this low, right? This was the extreme that came in to create the first mitigation on the 1 minute order block. That was the flip. Price came down. We have this zone here that created the new high. So this was part of the extreme that created this new push up. We got a V-shaped recovery on, I think it was like the 15-second time frame. Price came down and just kind of went through this demand zone and liquidated the initial mitigation into this price. And then what do we get? We get manufactured liquidity that's forming. This is near perfect mitigation after mitigation, basically just showing me that pretty soon the market is going to want to capitalize on this liquidity. And this is a place where price will more than likely just blast through when it eventually comes into that zone, right? So then what do we have? Failure of the supply flip, right? So demand to supply flip. This failed. We took it out. What do we have? We have this demand forming here. Let's speed this up so we can just see what's going on. All right, so at this point, what do we have? This trade has taken profit. The reason why I selected this level, although we had equal highs at the top, I did refine to this. I'm going to show you how important the lower time frames are. Look at this doji that we had that was unmitigated. This was an unmitigated doji candle. I'm only going to focus on the wick area, right? This was unmitigated. Price never came back to here, and this was the point at which we started to reverse. This did take out liquidity, so this is a liquidity point of interest in a way. While we do have relatively equal highs, liquidity stored up here for later, this one was still a liquidity point of interest. It took out liquidity and then created the this was the origin of the switch from being let's say bullish to now bearish, right? So this was an unmitigated extreme, and therefore I wanted to wait for price to come in to tap to that zone first to play it safe. What do we get? Price came in, tapped, we got a reaction down here, we respected this demand, we either could break out or just continue, and I just waited to take out. Once price came back to the same high, I just took profit, and that was it. So I now capitalized on the long 19.69R, and now I'm looking for what are we going to do at this point. We now came to a 1 minute unmitigated doji that was responsible for initiating the bearish order flow. It's now about 1 a.m. my time, so it's now officially London opened, and so now I'm waiting to see, is London going to flip the switch and now switch their intentions. This is what I was looking at. This was the demand chain that was being pushed down. Supply was now holding, so we had this unmitigated supply that came down. We ended up mitigating it here, and we swept it by just a little bit. So I highlighted the wick. What do we have? This area would be one of interest. Let's do this. Zoom a little bit here. This area was the extreme that ended up creating what? Push down, we got a point of interest reaction, we form an extreme, demand failure. So demand failed because of this extreme. You can see I drew a line here because I wanted to pay attention to see what was going to happen. At the same time, we had what? Unmitigated extreme up here. This was the extreme of the flip, right? What do we have? Price was hanging around here. Looked like it was going to respect, ended up liquidating the flip, and then price is pushing down. So because this took liquidity, and this was responsible for what? It looks like we're building a supply chain now. This is still hovering over us, so we're still paying attention to what could happen here. Price is pushing itself down. We get a reaction to the demand. This demand pushes up. It takes out liquidity internally, but it still respects this supply chain. What do we get? An aggressive reaction from here that pushes and takes out this demand. So now what do we have? Price is pushing down. We got an aggressive reaction here. I'm now looking potentially to take it short officially, right? So when price from here gives me a very aggressive reaction up, you're wondering, okay, well, what's going on? If that's happening very quickly, I want to see how this handles the reaction, because we could potentially take out this liquidity and come to this extreme and take a short from here. But that did not happen. So I'm going to show you how I had this order set up. I set my chart at 2 a.m. I usually stop trading, so I was around 2 a.m. right here. I did my setup. You could see 2 a.m. Price hit, and it continued. It ran perfectly, but I didn't take it because this is when I go to bed. So what do we get? Change of character from here. Price pushes up, is building liquidity here. And even though this is on the 1 minute, it's the same story as trading the higher time frame. We now have some inducement. Price comes up to what? To liquidate this extreme that created the break in demand. So this demand failed. This was the point that created the demand failure. We now swept it. Wick closed just a little bit above, or sorry, we wicked above but closed below. So that was just a sweep. That's officially for me, looking for change of character. And then what do we get? An aggressive push down, a reaction that creates what? Forms an extreme. This is a flip. And then what do we get? Failure of the demand. So at this point, we now have an official change of character. We've now broken demand several times. We've shown that we're building a supply chain, mitigation after mitigation, respecting, and that we're taking the lows. Because now we're seeing that the highs are protected and the lows are being targeted. Therefore, we wanted to take a trade off that. Now, we did not take this flip. And the reason why I didn't take this flip is because what? This was a liquidity point of interest. This zone right here, not only did we take liquidity, but this was the extreme of this entire leg that broke the structure. And if we take a look, kind of like what I was talking about earlier, let's see. how far into this are we on the 50%? While this wick does cover premium, we still have an unmitigated extreme. And so in the case that we have an unmitigated extreme, I'm not going to take a decisional point when we have this, especially because this took liquidity. So whenever something takes liquidity and it goes unmitigated, usually that's where we're going to see the best reaction from. And so what do we see? Let's see what happens. Price is coming in, tapped. At that moment we tapped. Now in this case, was I looking for an equilibrium entry? I would take the equilibrium entry if it was presented at that would have been a 1 pip stop loss. That would have been crazy. That would have been awesome, right? But in this case, we did have a lot of activity that happened here at the open, and so it would have been smart just to take this entry from here. Depending on spread, some people would have been triggered or not. I usually set my entries anyway, if I set them just a little bit below where I usually want to enter, just to be safe. So we didn't take this trade anyway, but we did have this setup marked up and it worked out perfectly. So let's just run with it, right? So it came in, tapped the open, so you're triggered in, and this is what's going on with price. Comes back to tap again, and then let's see, it already tapped. So at this moment, we already tapped our take profit. Why did we set that take profit? Let's go on the 5-minute time frame so we can kind of just show that. There we go. All right. So the reason why I set this as the take profit was because what do we have here? This is a weak high. This failed to break structure to the downside. So therefore, this is a weak high that has to go. But this is also a weak, this is also a weak level. This is a weak low, because this low failed to do what? It failed to take out the highest high up here. So we were short by about 1 pip. So because this did not result in a break of structure to the upside, let's say of swing structure in this case, this low will have to go. Because this did not result in a break of, let's say, swing structure to the downside, the high will have to go, right? So in this case, because the most recent reaction that we got was to the 1 minute doji here, and we got signaled with a change of character, what that tells me is before we're going to take out liquidity on this side, more than likely we will have to get more buy orders or more liquidity to come back before we come back up. And therefore, because we had a very aggressive push up with the early London session pushing up, we have a lot of empty space that has yet to be mitigated. And because we have such a buildup of orders here accumulating or distributing to push price lower, I was waiting for this low to go. And so you can see that this was a perfect 1 to 10.9, about what, 1 to 11 almost. And price came down to what? Take out our initial low. This was our initial lowest low at that point. And you can see we swept it, right? This was the low before we made the run up. And we took it out. So that was a great trade. And then what do we have? Let's take a look. Let's keep going. And stop. Let's show these. Let's comment. All right, perfect. So now what I wanted to show you is what do we have here? Remember that we still had this unmitigated extreme. So when this demand chain was forming, right, or sorry, supply chain was forming, and we got a reaction here, and we went low, what did we also do? We also built up a ton of liquidity here. Let's do this, liquidity top. All of that is liquidity. That's a lot of orders at the top that we still have to take out. And therefore, this wick here, that's the extreme, is someplace that I want to wait to see if we get a reaction from. Doesn't mean that we're going to set a trade just to go from here with an entry here, because that doesn't make sense. We could easily get liquidated. At the same time, if you remember, what do we have? We have equal highs here, and then we have equal highs here. So we already know we're going to take out the highs. The question is, will this be the move that officially takes it out? Because what did we do? We already went long. We came into here, we got a reaction, price came down to get more orders. We would assume that we gathered enough liquidity here to take out the highs, and we had all of this inducement here, as well as the liquidity built up at the top. But we're seeing now that based off of this reaction that we got to a 1 minute unmitigated extreme, we're seeing that the highs are being protected, and the lows are going to be targeted. So what are we looking for? When we get this, we're not setting a trade here, but we're waiting to see what happens. You see this long wick that came here to took out all the structural, or all this, let's say, supply chain that had formed in the past. Now what do we have? We have this low, and we're waiting to see what happens, because from this high to this low, this is the low extreme. We're waiting to see if we continue higher or if we fail. So at this moment, when we stop the chart there, we've officially changed of character. We've given a break to the downside. This low has failed to make a higher high and was now taken out. And therefore, we now know that price is getting more bearish momentum, or let's say an injection of bearish order flow. And now this extreme wick is where I would like to take my entry. Because it's unmitigated, I would like to set something in there. Now, in the past, earlier in this trading session, we saw that we got the majority of our trades from near open, right? And therefore, to be smart, we're going to follow whatever the market's doing during that day. If you're seeing the price is mitigating the equilibrium a lot during that trading session on previous supply chains or demand chains, then in that case, you might want to use the equilibrium. In this case, we saw already that the open was effective, so we're going to use the open again. Let's see what happens. Tap. All right, perfect. So once we come in, what do? We take out this structural liquidity. Well, not structural, sorry. This is inducement, is what I would call it. Inducement in here. Price came up, reacted here, pushed down. What did we do? This is like a flip. Price reacted here, formed an extreme, and then pushed down. This flip, this extreme did not take out any liquidity. Therefore, it's going to serve as inducement. We'll make more videos on that particularly later. What do we have? Price took out the inducement, therefore it did not need to come in for a deeper mitigation, did not need to take out this level. We got an aggressive reaction. The moment the price breaks 1 minute structure, we're now break even. Do I have a break even? I don't have it anymore. Well, at that moment, we're now break even on this trade. You know, if that fits your plan, I don't usually do that because usually my setups are right. But what do we have? We did form an order block just before we left. So potentially, price could come back up to this zone. Unlikely because we already broke structure to the downside, but because, and you'll see this in many cases, when price comes into tap to a point of interest, it might leave an unmitigated order block. In the case that it does that, you don't want to set your trade to break even because more than likely it will come back to take it or tap it, right? So in this case, if you really wanted to, if this was something that we came back to, this would have been a great re-entry. Now, I don't think it did that, but more than likely we just came down. What happens? There we go. And we're done, right? Or not yet. Still has more to go. And that's it. That's over. Now, what was our target for this? Well, let's go to the 5 minute. Give it a second to load. So much stuff on the chart. Well, as I showed you the refined lower time frame, so you can see what pops up when I'm talking about the refined stuff. Here, let's go to the 1 minute. Maybe lower than that. Here we go. So on the 15-second chart, what do we have? You can see the price is kind of, let's say, accumulating some orders here, right? Whoops. Do it the other way. We're accumulating orders here. What do we get? A push here. This looks like what? This is basically liquidated something in here. What do we get? A very aggressive reaction up that broke structure to the upside and swept all of the structure in here. Price came down. What did we do? We mitigated this demand zone. And then what do we get? Another aggressive reaction here. And therefore, in my case, because this was the extreme of that move, I would like to target this zone. Because this was where the first demand chain formed. And this is on a 15-second time frame. I mean, this is kind of crazy, right? But look, I mean, this is the extreme. The true extreme. After this, what price flew, right? And so, in the case of this was what day? That was the initial push into the 15-minute zone. Let's go here. Let's go to the 5-minute. So look, this was the initial demand that was unmitigated. We're talking about a 15-second unmitigated zone that pushed price into a 15-minute point of interest that reacted bearish. We created a demand chain that was forming with this as the first part of the demand chain, right? And so when price was coming down, what did it have to take out? It would have to take out this demand chain. And so price came down, and as you can see, perfect, it came in, tapped, took out this demand chain, ran a little bit further than that, and this was a 16.22 hour trade. And so the summary behind this video is use the power of supply chains and demand chains to show you what direction the market's telling you it's going to go. If you're starting to see a supply chain forming, right, and it's holding, more than likely you can find a great entry in that supply chain to take price short, just like this trade, right? If a demand chain is forming, more than likely you can find an entry to take the demand chain long. Because in this case, you're following the market's bias. It's very obvious that the market wanted to go long when it's forming a demand chain that is taking liquidity and breaking structure to the upside. When you find an unmitigated zone that broke structure, that's where you take your entry, right? Same thing here, right? Supply chain forming, we had an unmitigated zone that took liquidity that still respected supply, and this one broke structure. So an unmitigated zone that broke structure. Price came in, tapped, mitigated the zone, and then we're riding the supply chain. What do we get? Price comes back to the extreme. That's on a seconds time frame, right? Then what do we get? Price is pushing back up. What do we get? A reaction to a 1-minute doji candle that is 1 pip, right? Came in to react, gave us a reaction that ended up what? Creating an extreme that was unmitigated, that broke structure. Where did we enter? We saw inducement that was forming, which is liquidity that we're going to take, and we entered on an unmitigated extreme that took liquidity and broke structure, right? And that's how we took short. To do what? To come back to another extreme that was the initial reaction that created the demand chain that we're now taking out. And that's how you trade this type of strategy. So everything here that you saw was reaction based. We didn't just set up orders and wait for price to come to it. No, we saw that the market was structuring itself in a way that was creating protected lows or protected highs, right? And we entered off of reactions that were unmitigated, that broke structure or took liquidity, and we rode price until it came to another extreme, right? So that was a quick video. Well, I guess it's not a quick video, but I hope that that was a good video for you. We captured 19.69R. That's the trade I took. This is a trade I had set up that I did not take, but I was triggered in on my trading view setups. And this was a setup that we had that was 16.22R that presented itself during New York. So don't let anyone tell you that there's no setups during Christmas or during the holidays. Price is very predictable. It shows you exactly what it's going to do. It doesn't always look pretty, but if you have a good understanding of what price is doing, what price action is doing, it's very easy to find your setups, right? If you could make 50R just before Christmas on your account and you're risking 2% per trade, you just doubled your account in one day. So I hope you have a lot to take from this video. Once again, I'll see you next time, and have a good day. Merry Christmas.